the show. Hi, Pankaj. A very good morning. Great to be speaking with you. Firstly, help us with your take. What are you really penciling in for the markets? Because of late, there's a lot that's been happening globally. We are amidst the tariff uncertainty, what implications it could have on the business. But back home, some of the macro indicators are boding well. Give us your sense on the Indian markets and where do you see us heading from here on?
Sure. Hi, good morning. I think I've maintained this all throughout that we are very much in a bull market, and my simple definition of bull market, I draw inference from the original Dow Jones theory that on a full year basis, markets will give positive returns. So I still firmly remain in the camp that markets will yield positive returns on an annualized basis. Having said that, I've been saying this that it's a very matured bull market because now we are in the sixth year of this bull market. The bull market started right at the onset of COVID-driven lockdowns. And in the last 5 years, a lot of low-hanging fruits have been taken off. Money has been made. Valuations are expensive. India is the most expensive equity market in the world. And in midst of all of this, we need to consider the fact that we are in the midst of a cyclical slowdown, partly because of internal factors and partly there are global trade headwinds. Yet probably India is the best placed market in the world. So my still view is that from here on, if I take a view, I still think that we'll see recovery in earnings growth going forward this year onwards, and probably Nifty can do a low double-digit earnings growth, and markets can do similar returns. So our view on markets remains still constructive. Having said that, investors will have to pick and choose sectors and stocks to drive higher returns. At the index level, returns will be probably in line with high single digit or low double digit, which is still not bad in a matured bull market at this stage of cycle at where we are.
Pankaj bhai, good morning. You're not recognizing my voice. Bad cold, pardon me.
Sorry. Sorry, Nikunj.
I really have bad cold, man. People can't recognize my voice now. Is it? I'm sounding that different, is it?
No, now it's better.
Okay. What are you doing with your internet stocks?
Well, to be very honest, Nikunj, we've taken some money off because a theme which was outlier, there's a lot of fear and mispricing. The clock has turned the other way, where now once again we see a lot of jubilation. Valuations in some of the companies that we liked are now pricing in growth far too out in the future. The point here, if I may say so, in this whole internet stocks is your ability to pick stocks which will be strategic winners over the next 5-10 years. Because my view is the industry leaders will make the top 2 or 3 players in every industry or segment will make 130, 140% of industry profits, which effectively means the balance, all the players will lose money. Now, your ability to pick the winner is very important. And then picking that at the right valuation. So, for example, I'm just saying you take the case of food delivery. When Zomato at $50, probably we knew that there is a significant amount of profit pool in the food delivery space, and the stock was mispriced. But today, probably, I think it's pricing in too much. So still they remain a leader. I think they'll do well over the medium term, but I still think that the near-term gains are not there over the next 12, 18 months in stock prices. So from because we manage clients' money, we have to look at returns from a next 2 to 3 year perspective. So while strategically I continue to remain very positive in the space, but yes, we have taken some money off in some of these names.
I'm working with an assumption that earnings are not going to be super. They would be good, but they will not be gangbusters. Which means there would be a struggle to find companies which will grow even at 15%. So for next 3 years out, if one has to make a basket of companies which can grow 15 to 20% in top line, maybe 15 to 20% or 20 to 25% in bottom line, how would you make that basket? Because that in a sense will be the most important basket for next 3 years. Buy companies where valuations may not be that stretched, but growth of 15% top line, 15 to 18% bottom line is predictable.
Absolutely, Nikunj. I think you hit the hammer on the nail. I think the key thing is while aggregate earnings growth at the aggregate level are, let's say, low double digits, there are pockets of markets across sectors where growth is high. And then you have to find companies or sectors, companies which are trading a reasonable valuation. Meaning, just to place in context, for example, EMS companies are delivering very high growth, but essentially, I think there's not much money left on the table in these companies because they're priced to perfection. So you're okay with somewhat lower growth, maybe a mid-teens or high-teens growth, where valuations are more reasonable. Because effectively, what matters for investors or shareholders is your expected returns or returns you make, and you can make those with moderate earnings growth also. So I think it's all about picking specific stocks within sectors. And it's all boils down to one business model, more importantly, to management teams and their execution capabilities. Managements who are doing, execution at a more strategic level in terms of driving growth, and which is where these companies can deliver outlier growth despite headwinds either domestically or globally. So at a high level, one of the meaning coming back to your question, what we like is obviously the top 4 or 5 banks in India. So now we own the top 4 banks in India because we think valuation there are very much reasonable. And one of the few sectors which is still trading at discount to Nifty index. So in that sense, valuations are pretty reasonable, and probably it's good to own these for a 15 mid-teens to high-teens kind of KG returns over the next 3 years. So that is one pocket of market clearly. Second pocket is where we made a portfolio pivot in the last 6 months, I would say, is towards consumer and consumer-oriented stocks, because these sectors underperformed in the last 5 years. Valuations are now pretty much in line with long-term averages. And more importantly, now we can see companies which probably can, one, we believe that overall we'll see a revival in consumption going forward. And within that, then our strategy is to pick companies which are, through their organic or inorganic initiatives, probably will deliver much higher growth than the industry growth in that sense. So that's one pocket where I clearly think that probably one can look at, returns which can be probably high teens kind of a thing. And then lastly, we own some of the internet companies because I still think that they can still grow at 25-30% CAGR over the next 5 years, 7 years, and where valuation is reasonable. So we'll still continue to own them. So these are the broad 3 categories I would bucket in terms of looking for mid-teens to high-teens kind of a return. And at the portfolio level, I think a high-teens kind of a return where index returns are going to be, low double digits. It's a fantastic outcome at this stage and at this cycle of the market with moderate risk or low risk.
So now that you've identified, you've sketched the picture for us, let's fill in the colors. 3 sectors. When I say fill in the colors, what are your top holdings or top ideas within these 3 categories which you have?
Sure. So within large banks, we own HDFC Bank, meaning we bought HDFC Bank after a gap of 3 years. We clearly think that for the last 3 years they were undergrowing the industry growth rate. The bank went from being the fastest growing private sector bank in India for 25 years. Last 3 years has been more consolidation because of the merger. We think they're getting back to industry leading growth probably in the 4 quarters from now. So we own HDFC Bank and also Kotak Bank now in amongst the larger banks. So and ICICI Bank obviously remains part of the portfolio, and which we think which has been executing pretty well. So these are the top 3 banks that we own. Within consumers, we own names amongst large, and our ownership is across staples and consumer discretionary. So within staples, but we like companies which are making significant, taking significant initiatives to drive growth. So we own companies like Tata Consumer and Godrej Consumer because while some part of their business is staples, but we think they're making significant investments both organically and inorganically to drive, category extensions and get into new categories to drive growth. PFC, private final consumption expenditure at the aggregate level is $2.6 trillion, which is higher than if I were to just put that in context, that would have been the 10th highest, higher than the top the 10th country in terms of GDP rankings. And that is growing at 10-12%. So effectively, we are adding about $250-300 billion of consumption. Now it's left to companies who can execute and take a significantly higher share of that. And that's what we are looking for when we are investing into some of these companies in terms of their approach to business and their strategy. Within discretionary, we own Jubilant Foods as one company. We clearly think that pizza as a category in India at the organized level is grossly underpenetrated, and there's a huge runway for penetration growth in that category. So we own that. We own some companies in consumer durables because in a lot of categories in consumer durables, we still think penetration levels are low. Companies which can do a good job in terms of execution on the ground can still deliver, high teens or mid-teens kind of a growth. So these are some of the companies that we own across the consumer. And within internet, we still continue to own companies like Paytm and InfoEdge, and do have small holdings in food delivery in Zomato. But yes, we've taken money off the table as well in some of these companies. We are closely looking at. We have small ownership in some of the consumer tech companies on the digital or internet side, the likes of Nykaa and FirstCry, because and we're still evaluating them. But some of these, I believe, some of larger consumer companies will emerge amongst this basket of new age internet consumer tech companies.
Very interesting opportunities out there, and if the market does correct, it only becomes more attractive. Pankaj, good to have you on the show. Thanks as always for your time.
Sure. Thank you so much.